Welcome, students, to Chapter 9, Recording Payments. I am genuinely pleased you are here, because this chapter is one of the most practical chapters in your whole course. When you understand how to record payments correctly, you are learning how real businesses protect their cash, prevent mistakes, and produce reliable financial records that managers, auditors, and tax authorities can trust. By the end of this chapter, you will feel much more confident about what happens from the moment a business decides to pay, all the way to the moment that payment appears in the accounting records. In this chapter, we focus on three main topics. I will explain them clearly now, so you know exactly what you're going to learn and why each part matters. First topic, controls over recording payments. In this part, we learn why payment controls exist and how they reduce the risk of fraud and error. Payments are a high-risk area because money is leaving the business. So we need rules and procedures that make it difficult for someone to pay the wrong person, pay the wrong amount, or hide an unauthorized payment. You will study ideas such as authorization, checking supporting documents, keeping proper records, and making sure different people handle different steps in the payment process. You will also connect this topic to one of the most important controls of all, which is bank reconciliation, because bank reconciliation helps detect payments that were not recorded correctly, or payments that were recorded but did not actually go through the bank. Second topic, posting cash payments to the general ledger. In this part, we learn how to record payments in the accounting system using double entry. You will practice taking a list of payments and turning them into correct entries in the general ledger. This includes understanding which accounts are affected, such as bank, trade payables, expenses, non-current assets, and discounts received when settlement discounts apply. The key skill here is accuracy. Every payment must be recorded in the correct account for the correct amount on the correct date with clear narration and good documentation. Third topic, automated credit systems. In this part, we learn what happens when payments are not made by cash or check, but are made electronically through the banking system. This includes systems that allow regular payments to be made automatically, such as standing orders and direct debits, and also systems used for paying staff wages or salaries through electronic transfer. You will learn the basic procedures, the type of information needed, and why automated systems can save time and reduce paperwork, while still needing strong controls to prevent mistakes and unauthorized payments. As we go through Chapter 9, keep this big idea in your mind. A payment is not just money leaving the business. A payment is a transaction that must be authorized, supported by evidence, recorded correctly, and then checked against the bank so the records remain complete and trustworthy. Now that you know the topics, we are ready to begin Chapter 9 properly, starting with controls over recording payments and understanding why the business must treat payments as a high-priority area for strong internal control. Lesson 1. Controls over recording payments. Students, in this lesson, we are learning something extremely important. We are learning how a business protects its money when it makes payments. Because when a business pays money out, it is very easy for mistakes to happen, and it's also an area where fraud can happen if there are no strong rules. So Lesson 1 is about the rules, checks, and procedures that make sure every payment is correct, authorized, and properly recorded. What do we mean by controls over payments? A control means a safety rule. It is something the business does to prevent problems. Controls are like locks on a door. Not because we do not trust people, but because money is valuable and mistakes are expensive. So controls over recording payments mean rules and procedures to make sure the payment is allowed, the payment is correct, the payment is recorded properly, the payment is not missing from the records. Why do we need strong controls when recording payments? Because payments are risky. When a business receives money, money comes in. When a business pays money, money goes out. So the danger is higher. Here are the main risks. 1. Paying the wrong person. 2. Paying the wrong amount. 3. Paying twice for the same invoice. 4. Paying for something that was never ordered. 5. Paying for something that was never received. 6. Someone creating a fake payment and stealing money. 7. Forgetting to record a real payment in the accounting system. 8. Recording a payment in the wrong account. So you can see, Controls protect the business from mistakes and from dishonest actions. The two big goals of payment controls. In this chapter, the book mainly focuses on two big goals. Goal 1 is preventing fraud. Fraud means an unauthorized payment or a dishonest payment. We will cover fraud in lesson 1.1 after this. Goal 2 is completeness. Completeness means every payment that happens must be recorded. No payment should be missing from the accounting records. So lesson 1 is about protection and accuracy. How does a business control payments in real life? Now imagine you work in the accounts department. A supplier sends an invoice. The business needs to pay that supplier. A strong system will normally follow these stages. Stage 1, check the documents. Stage 2, approve the payment. Stage 3, make the payment. Stage 4, record the payment in the accounts. Stage 5, check the payment later against the bank. Let us walk through each stage slowly. Stage 1, check the documents before paying. Before paying, the business must confirm the payment is genuine. This means the accounts team checks things like, is there a real supplier invoice? Was the order actually made? Did the goods arrive or did the service get completed? Do the prices match what was agreed? Is the invoice total correct? Are the calculations correct? Is the invoice already paid or not yet paid? This is very important because if you pay an invoice that is wrong, then the business loses money. Also, if you pay a fake invoice, that is fraud. So checking documents is the first protective wall. Stage 2, authorization, meaning approval. Authorization means permission. A payment should not be made just because someone asks. A responsible person must approve it. For example, a senior accountant, a finance manager, or another authorized officer. The approval confirms, yes, we owe this money. Yes, we received the goods or service. Yes, the amount is correct. Yes, the payment should be made now. This protects the business because payments are not decided by junior staff alone. They must be approved. Stage 3, making the payment safely. Now, after approval, the payment is made. This can be done by check. It can be done by bank transfer. It can be done through standing order. It can be done through direct debit. It can be done by cash for small amounts. Whatever method is used, controls are still needed. For example, with checks, checkbooks must be kept secure. Checks should be signed only by authorized signatories. Some businesses require 2 signatures for larger checks. This reduces the risk of one person paying money to themselves. For bank transfers, there should be password control. There should be access limits. Often one person sets up the payment and another person approves it. This again reduces fraud risk. So the payment process must be controlled, not casual. Stage 4, recording the payment correctly. After the payment is made, the accounting records must be updated. This means posting the payment. For example, if we pay a supplier, we normally reduce trade payables and we reduce the bank balance because money has left the bank. So the entry often becomes debit trade payables, credit bank. This recording must be accurate. The correct supplier must be recorded. The correct date must be recorded. The correct amount must be recorded. The correct account must be used. If the payment is recorded incorrectly, the accounts become unreliable. Then the trial balance and financial statements can also become wrong. Stage 5, the most important control, bank reconciliation. Now I want you to listen carefully to this part, because it is one of the most powerful controls in accounting. Bank reconciliation means we compare the business bank account records with the bank statement. The idea is simple. The business has its own bank account record in the ledger. The bank also has a record of what happened, shown on the bank statement. If a payment was made but not recorded in the ledger, the bank statement will show it. If a payment was recorded in the ledger but did not happen in the bank statement will not show it. So bank reconciliation helps the business find problems. It helps find missing payments. It helps find unauthorized payments. It helps find timing differences, like checks issued but not yet presented. It helps find bank charges and bank interest that the business has not yet recorded. That is why the book emphasizes bank reconciliation as the most important control, because it is an independent check. It does not depend only on internal paperwork. It is checking against the bank's evidence. A very important control idea, separation of duties. One major control principle is called segregation of duties. This means different people do different parts of the work. Why is this important? Because if one person can do everything, then fraud becomes easy. They can create a payment, approve it themselves, make the payment, and record it, and they can hide it. But if different people handle different tasks, fraud becomes difficult. A good separation might be like this. Person 1 prepares the payment details. Person 2 approves the payment. Person 3 signs the check or releases the bank transfer. Person 4 records the payment in the accounting system. Person 5 reviews the bank reconciliation. This is how real businesses protect themselves. Examples of problems and how controls prevent them. Let us do simple examples so everyone understands. Example 1. Paying twice. A supplier invoice is received. A junior staff member pays it, but the invoice was already paid last week. How do controls prevent this? The accounts team checks the supplier account first. They check whether the invoice is outstanding or already settled. Example 2. Paying the wrong amount. An invoice total is calculated wrong. The business overpays. How do controls prevent this? The invoice is reviewed. The calculations are checked. The payment is authorized by someone senior. Example 3. Unauthorized payment. Someone creates a fake supplier name. They prepare a payment to that fake supplier. How do controls prevent this? Payments must be approved. Supplier details must be verified. Different people handle approval and payment. Bank reconciliation may reveal unusual payments. Example 4. Payment made but not recorded. A payment goes through the bank, but it was not posted into the ledger. How do controls prevent this? The bank reconciliation will identify it, because the bank statement shows the payment, but the ledger does not. What lesson 1 is teaching you for the exam? In exam questions, they may ask, why do we need controls? What controls prevent fraud? What controls ensure completeness? Why is bank reconciliation important? Why is segregation of duties important? So when you answer, you should always connect controls to the reason. Controls reduce risk. Controls improve accuracy. Controls protect cash. Controls make the accounting records complete and reliable. Quick summary of Lesson 1. Lesson 1 teaches us that payments must be controlled. Payments must be checked using documents. Payments must be authorized by the right person. Payments must be made securely. Payments must be recorded correctly. Payments must be checked later, especially using bank reconciliation. This creates a strong system that prevents mistakes and prevents fraud, and it ensures all payments are recorded, meaning completeness. Now that we understand Lesson 1 clearly, we will be ready to study Lesson 1.1 next, which is fraud. And we will go even deeper into how fraud happens and exactly what procedures prevent it. 1.1. Fraud. Students, now we are moving to one of the most important parts of Chapter 9. Fraud is one of the biggest dangers in payments, because when money leaves the business, it can be stolen more easily than when money comes in. That is why every good accounting system must have controls that stop fraud before it happens. What fraud means in accounting? Fraud means a dishonest action. It is when someone intentionally tries to take money or assets that do not belong to them. So fraud is not a normal mistake. Fraud is done on purpose. In this chapter, the main fraud risk is an unauthorized payment. This means a payment that should not have been made. It was not approved properly. It was not real, or it was made to the wrong person on purpose. Why fraud often happens in the payments area? Let us think like real accountants for a moment. Payments are risky because money goes out of the business. Many payments happen every week. There are many invoices and many suppliers. Sometimes people are busy and rush. Sometimes people trust paperwork without checking. A dishonest person can use this busy environment to hide fraud. Also, fraud can happen because a person believes nobody will notice. But the accounting system is designed to notice. That is why controls exist. What does an unauthorized payment look like? Let us make this simple. An unauthorized payment can happen in many ways. Here are the most common ways. 1. A fake supplier is created. The fraudster creates a supplier name that looks real. Then they prepare an invoice. Then they arrange a payment to that supplier. But the supplier is not real. The money is actually going to the fraudster. 2. A real supplier is used, but the bank details are changed. The supplier name is real, but the payment is redirected to the fraudster's bank account. 3. A payment is made for goods that were never received. The invoice arrives, but no goods arrived. Still, the business pays. This might be an inside fraud or a weak checking system. 4. Paying more than the invoice amount. The fraudster increases the payment amount. For example, the invoice is for $1,000, but the payment is made for $1,500. The extra amount is stolen. 5. Paying the same invoice twice. This can be done by mistake, but it can also be used as fraud, because the fraudster may try to make the second payment to themselves. 6. Paying personal expenses using company money. For example, someone claims a personal cost as a business cost. Then they try to get the company to pay it. So you can see, fraud is usually connected to weak controls and weak checking. Why fraud can be difficult to see immediately. The book explains a very important point. When someone makes an unauthorized payment, they try to hide it, because there is a control called bank reconciliation. If the payment is not recorded in the accounting system, it can later be found when reconciliation is done. That is why fraudsters often record it in the system to make it look normal. So fraud can be hidden inside the accounts unless strong controls exist. What controls does the book require to prevent fraud? Now we come to the heart of Lesson 1. Point 1. The book gives key procedures that should be in place. These procedures make fraud difficult. Let us explain them one by one in a very clear way. Control 1. All payments must be authorized correctly. This means no payment should be made without approval. Approval must come from the correct person. Approval must happen before money is paid. This stops fraud because a fraudster cannot easily pay money out without permission. So the key idea is no authorization, no payment. Control 2. Proper checks must be made against supporting documentation. Supporting documentation means proof documents. For example, a supplier invoice, a purchase order, a goods received note, a delivery note, a supplier statement, a remittance advice, any official document that proves the payment is real. The accounts department must check the documents carefully. Is the supplier real? Is the invoice genuine? Is the amount correct? Were the goods received? Is the invoice already paid or still unpaid? This control stops fraud because a fake invoice will usually fail the checking process. Control 3. Segregation of duties, meaning separation of responsibilities. This control is extremely powerful. The person who writes the check must not be the same person who records the payment in the accounts. Why? Because if one person does both jobs, fraud becomes easy. They can write a check to themselves, then record it as something normal. For example, they record it as office expenses. Now it looks correct on paper, but it is theft. But if different people do different tasks, fraud becomes difficult. A strong system might work like this. Person A prepares the payment. Person B approves the payment. Person C signs the check or releases the bank transfer. Person D records the payment in the ledger. Person E reviews the bank reconciliation. So no one person controls everything. Control 4. At the end of each day, a list of payments is submitted to a senior person. This means every day the business prepares a list showing all payments made that day. Then a senior member of staff checks it. This is like a daily review. It helps discover unusual payments quickly. For example, a payment to a supplier name that is unfamiliar, a payment amount that is unusually high, a payment made twice, a payment that does not match the normal pattern. This control works because senior people often notice things that junior staff might miss. Control 5. A minimum number of checkbooks should be in use at any time. This is an important physical control. If too many checkbooks are in use, it becomes harder to track checks. It becomes easier for checks to disappear. It becomes easier for fraud to happen. So the business should keep checkbooks secure and use only the minimum needed. This makes control tighter and tracking easier. Control 6. Bank reconciliation will help detect unauthorized payments. Even if fraud happens, bank reconciliation is a strong detective control because it compares the business records and the bank statement. If a payment goes through the bank but was not properly recorded, reconciliation can reveal it. If an unusual payment appears, the business can investigate. So reconciliation is like the final alarm system. A classroom example to make fraud easy to understand. Imagine a business called Bright Office Supplies Limited. A dishonest employee wants to steal money. They create a fake supplier called Fast Stationery. They create an invoice for $700. They print it to look official. They submit it for payment. If there are no controls, the business pays it. But with controls, this is what happens. The payment must be authorized. So a manager asks, who is this supplier? Then they check the purchase order. No purchase order exists. They check delivery records. No delivery exists. The invoice fails the checks, so payment is rejected. That is how controls stop fraud. Why the book says fraud is usually small amounts. The book gives a realistic warning. Most people cannot carry out huge frauds easily because large payments are more visible. Large payments need more approval. Large payments attract attention. So many frauds happen in small amounts, repeated many times. For example, taking $50 several times instead of stealing $50,000 one time. Small frauds can still become large over time. That is why controls must work for every payment, small or big. Exam-focused points for Lesson 1.1. In the exam, you may be asked questions like these. Explain why fraud is a risk in recording payments. Describe controls that prevent unauthorized payments. Explain why segregation of duties is important. Explain why authorization is necessary. Explain how documentation checks reduce fraud. Explain the role of bank reconciliation in detecting fraud. When you answer, always use this structure. First, state the fraud risk, then state the control, then explain why the control works. For example, risk. A dishonest employee may create an unauthorized payment. Control. All payments must be authorized by a senior person. Reason. This ensures no payment is made unless it is approved and verified. That is a perfect exam-style explanation. Common student mistakes in understanding fraud controls. Let me warn you about mistakes that students often make. Mistake 1. Students say bank reconciliation prevents fraud, but actually bank reconciliation usually detects fraud after it happens. It is more like a detective control. Mistake 2. Students forget supporting documents. Always remember, in accounting, documents are evidence. Mistake 3. Students do not understand segregation of duties. They think one person doing everything is faster. Yes, it is faster, but it is dangerous because it creates an opportunity for fraud. Mistake 4. Students confuse fraud with errors. Error is accidental. Fraud is intentional, so always keep that difference clear. Short summary of Lesson 1.1. Fraud means dishonest behavior. In this chapter, fraud mainly means unauthorized payments. Fraud happens when controls are weak. The book gives key controls to prevent fraud. Authorization of all payments. Checking supporting documentation carefully. Segregation of duties, so one person does not control everything. Daily payment list reviewed by a senior person. Minimum checkbooks in use and secure storage. Bank reconciliation to detect unusual payments. When these controls are followed, fraud becomes very difficult. Now that you understand Lesson 1.1 properly, we are ready to go deeper into the detailed procedures in the next parts of this chapter. 1.2. Completeness. Students, now we are moving to Lesson 1.2, which is called Completeness. This lesson is extremely important because even if there is no fraud, the accounting records can still become wrong if they are not complete. When we say completeness in accounting, we mean one simple idea. Every payment that the business makes must be recorded in the books. Not some payments, not most payments, all payments. If even one payment is missing from the accounting system, then the accounts will not be accurate. What completeness means in real life. Let me explain this in a very practical way. Imagine a business pays 10 suppliers this week. If the accountant records only 9 payments, then the accounts will show too much cash remaining. Also, the supplier balances will show wrong amounts, and the expenses might be wrong too. So completeness means nothing must be forgotten. Nothing must be left out. Nothing must be recorded late. The accounting system must capture every payment. Why completeness is a big risk in payments. Now you might ask, why is it so easy for payments to be missed? The book explains the reason very clearly. Sometimes a payment is made, but it is not recorded in the accounting system at that moment. Nobody notices immediately, and the business continues working normally. But later, when the payment clears through the bank, it will appear on the bank statement. So the missing payment is often discovered later, not at the time it happened. This is why completeness is so important, because missing payments do not always show up immediately. Why missing payments cause serious problems. If payments are missing from the books, several problems happen. Problem 1. Cash or bank balance becomes wrong. If a payment was made but not recorded, the books will show more money than the business actually has. Problem 2. Supplier balances become wrong. The supplier might be paid, but the books still show that the supplier is unpaid. This makes the trade payables ledger incorrect. Problem 3. Expenses and costs become wrong. If an expense payment is missing, the business may understate its expenses. That makes profit look higher than it really is. Problem 4. The business may pay again by mistake. This is a very realistic danger. If the system shows the invoice is still unpaid, someone might pay it again. That creates duplication and cash loss. Problem 5. Bank reconciliation becomes difficult. Because reconciliation depends on matching book entries with the bank statement. Missing entries create differences that waste time. So completeness is not a small issue. It is a very serious issue. How the book says we ensure completeness. Now we focus on the controls the book gives us. These controls are designed to make sure all payments are recorded. I will teach them one by one, clearly and with examples. Control 1. Regular bank reconciliations must take place. This is the most important control. A bank reconciliation compares the bank statement balance and the business cash book or bank ledger balance. If a payment went through the bank but is not in the books, the reconciliation will reveal it. So bank reconciliation acts like a safety net. It catches missing payments. Example. Suppose the business writes a check for $500 to a supplier. The check is sent, and later the supplier cashes it. The bank statement shows the payment, but the accounts clerk forgot to record it. During bank reconciliation, the accountant will see a payment on the statement that is not in the ledger. Then they investigate it and record it. So the books become complete again. That is why the book says regular bank reconciliation is essential for completeness. Control 2. Checks should be issued in sequence. This means checks must be used in numerical order. For example, check number 1001, then check number 1002, then check number 1003. Not random numbers, not skipping around. Why is this important? Because if checks are issued in sequence, it becomes easier to notice missing checks. If check number 1004 exists, but suddenly you jump to 1007, then we immediately ask, where is check 1005? Where is check 1006? Maybe they were canceled. Maybe they were written but not recorded. Maybe they were lost. Or maybe something suspicious happened. So issuing checks in sequence protects completeness. It helps us ensure no check is missing from the records. Control 3. A sequential check should be carried out on checks entered in the bank ledger account. This control is very powerful. The book says that a check should be carried out to confirm that all checks written are entered in the bank general ledger account. In simple words, we must check that every check number is recorded in the bank ledger. So what happens? A list is made of checks written. Then the bank ledger entries are checked to ensure every check appears there. This stops missing entries. Because even if the check has not cleared the bank yet, it should still be recorded as soon as it is written. So the business is recording payments at the correct time. Control 4. This sequential check should be done by someone other than the person who records checks. This part is extremely important. The book is saying, the person who performs the check should not be the same person who records the checks. Why? Because if the same person records and checks, then a mistake can stay hidden, or a dishonest person can hide missing checks. But if a different person checks, then errors and missing entries are more likely to be found. So this is another example of segregation of duties. It supports completeness by adding independent checking. Control 5. Regular examinations of bank statements to ensure certain payments are recorded. The book specifically mentions direct debit and standing order payments. These payments are special because they can happen automatically. Let us understand this properly. A standing order is a payment set up to go out regularly, usually the same amount each time. For example, monthly rent. A direct debit is also a regular payment, but the amounts can vary and the supplier collects the money. For example, electricity bills, internet bills, telephone bills. Now, what is the problem? Because these payments happen automatically, the accounts team might forget to record them in the books. They may not prepare a check. They may not actively process the payment. The bank just takes the money, and later it shows on the statement. So the book says, bank statements should be examined regularly, probably weekly, to make sure all standing order and direct debit payments have been recorded in the bank ledger. This protects completeness because it ensures automatic payments are not missed. A very clear classroom example. Imagine this situation. A business has these automatic payments. Rent paid by standing order every month. Telephone bill paid by direct debit. Electricity bill paid by direct debit. Now, suppose the accountant is busy and forgets to record the telephone direct debit this month. The bank statement will show that the payment has gone out. But the accounting records might not show it. That means expenses are understated, and the bank balance in the ledger is too high. But if the business regularly checks the bank statement, they will catch it quickly and record it. So the accounting records become complete again. Why completeness is connected to accuracy and reliability. Completeness is like the foundation of good accounting. If records are incomplete, then accuracy becomes impossible. Because accuracy means the numbers are correct. But if entries are missing, the numbers cannot be correct. So completeness supports accurate financial statements, correct supplier balances, correct expense recording, proper cash control, and this is exactly what accountants are responsible for. How to write completeness answers in exams in a perfect way. In the exam, if you see the word completeness, you should automatically think of this structure. First, state the risk. Payments may be made but not recorded. Second, state the main control. Regular bank reconciliation. Third, add supporting controls. Checks issued in sequence. Sequential checks on check numbers. Independent checking by a different person. Regular review of bank statements for standing orders and direct debits. Fourth, explain why each control works. Because it helps identify missing payments and ensures every payment is included in the records. This is how you get full marks. Common mistakes students make about completeness. Mistake 1. Students think completeness is the same as fraud. No, fraud is intentional wrongdoing. Completeness is about ensuring nothing is missing, even by accident. Mistake 2. Students think you only record payments when they appear on the bank statement. That is wrong. Payments like checks should be recorded when they are issued, not when they are cashed, because the payment decision happened already. The business already committed to pay. Mistake 3. Students forget automatic payments. Standing orders and direct debits are easy to miss because nobody physically writes a check. So always mention bank statement checking for these. Final summary of Lesson 1. Point 2. Completeness means every payment must be recorded in the accounting system. Payments can be missed because they might not be recorded when made, and the mistake might only be noticed when the bank statement shows the payment. To ensure completeness, the book requires these controls. Regular bank reconciliations, checks issued in sequence, sequential checks on checks entered in the bank ledger, independent checking by someone else, regular checking of bank statements for standing orders and direct debits. If these controls are followed, the business will have complete payment records and the accounts will be reliable. What the question is about. The question says that Ferdy's Furniture already has some procedures, rules in place for recording payments. Your job in the exam is not to calculate anything and not to write journal entries. Your job is to comment on the reasons for each procedure. Meaning, you must explain what each rule is trying to achieve, such as preventing fraud, preventing mistakes, making sure all payments are recorded, making sure no payment is missing, making sure payments are authorized, making sure records are accurate and trustworthy. So this is an internal control question. What the question gives you? The question gives you 5 procedures and labels them, A, B, C, D, E. Each one is a rule that Ferdy's Furniture follows when they pay suppliers and record those payments. What the question is asking you to do, the task says, comment on the reasons for each of the above procedures. This means for each procedure A to E, you must write an explanation that answers this. What is this rule doing inside the business? Why does the business need this rule? What problem does it prevent? How does it protect the business money and records? So the examiner wants you to show that you understand why these controls exist. Explanation of each procedure in simple words. A. Only one checkbook is to be in use at any one time. This means the business should not use two different checkbooks at the same time. So the company decides, we will use one checkbook only. When it finishes, we move to the next checkbook. The question wants you to explain what benefit this rule gives to the business. B. Numbers of all checks are to be entered in the bank general ledger account, even where the check is canceled. This means every check has a check number. Even if the check is canceled and not used, they still record that check number in the bank general ledger account. The bank general ledger account is the accounting record that shows all money movements through the bank. So the question wants you to explain why it is still important to record canceled check numbers. C. All canceled checks are to be retained. This means, if a check is canceled, they do not throw it away. They keep it safely as part of records and documents. So the question wants you to explain why the business must keep canceled checks instead of destroying them. D. The tasks of writing checks and writing up the bank general ledger account are to be carried out by different people. This means one person prepares or writes the check. Another different person records the payment into the accounting system and bank ledger. So the same employee should not do both jobs. This is describing a very important control called separation of duties. The question wants you to explain why separating those jobs is important. E. Authorized details of all standing orders and direct debits are to be filed, and the details of any such payments are to be agreed to the file before being transferred from bank statements into the bank general ledger account. This is the longest one, so let's break it into simple parts. Standing order means a regular payment set up by the business, paid automatically, usually a fixed amount. Example, rent payment every month. Direct debit means another automatic payment method. The supplier takes money from the business bank account. Example, electricity bills or phone bills. Now the procedure says the business must keep a file of authorized standing orders and direct debits. When a payment shows on the bank statement, the accountant must check it matches the authorized file. Only then they record it into the bank general ledger account. So the question wants you to explain why this checking step is necessary before recording the payment, what your final answer should look like in the exam. The question expects your answer to be structured like this. Procedure A. Explain what the rule means. Explain the purpose of the rule. Procedure B. Explain what the rule means. Explain the purpose of the rule, and so on until procedure E. You should connect your explanation to control ideas like fraud prevention, completeness, accuracy, authorization, security of documents, clear audit trail. Procedure A. Only one checkbook is to be in use at any one time. This means the business should only use one checkbook at a time. They should not use two checkbooks together. They should finish one checkbook first. Then they can start the next checkbook. This is a good control for several reasons. First reason, it prevents missing checks. Check numbers come in order. For example, check number 101, then check number 102, then check number 103. If the business uses only one checkbook, the numbers stay in order. Then it becomes easy to notice if a check is missing. If check number 104 is missing, the business notices quickly. A missing check can be a serious issue. A check can be missing because of a mistake. A check can also be missing because somebody took it. Second reason, it makes checking easier. When check numbers are in order, the account staff can check quickly. They can match checks to the bank statement more easily. This makes the records more organized. This also saves time. Third reason, it improves security. Unused checkbooks can be kept locked away. Only the active checkbook stays in use. This reduces the risk of someone stealing blank checks. A blank check is dangerous. If someone steals it, they might try to use it dishonestly. So using one checkbook at a time is safer. Procedure B. Numbers of all checks are to be entered in the bank general ledger account, even where the check is canceled. This means that every check number must be recorded. Even if the check is canceled, the check number must still be recorded. So the bank general ledger should show a complete list. It should show checks that were used and paid. It should also show checks that were canceled. This is a good control for several reasons. First reason, it creates a complete record. In accounting, we want a clear history of what happened. This is sometimes called an audit trail. An audit trail means we can trace every action. For example, imagine check number 210 was canceled. If that check number is recorded, the business can explain it clearly. They can say that the check was canceled and recorded. Nobody will be confused. Second reason, it prevents dishonest behavior. If canceled checks are not recorded, a dishonest person can hide things. They may cancel a check and then try to use it later, or they may remove evidence of what happened. But if every check number is recorded, it becomes harder to hide anything. Third reason, it helps bank reconciliation. Bank reconciliation compares the business records with the bank statement. If check numbers are missing, reconciliation becomes difficult. If check numbers are complete, reconciliation becomes easier. So this control supports accuracy and completeness. Procedure C. All canceled checks are to be retained. This means canceled checks must be kept. They must not be thrown away. They must not be destroyed. They should be filed safely. Canceled checks are important evidence. This is a good control for several reasons. First reason, canceled checks prove what happened. If a check was canceled, the business must be able to prove it. Keeping the check shows it was canceled properly. It shows the check was not used. It shows the cancellation was real. Second reason, it prevents fraud. If canceled checks are not kept, someone may take them. A dishonest person could try to change details. A dishonest person could try to use the check. But when canceled checks are kept and secured, fraud risk reduces. Third reason, it helps managers and auditors. Managers may check the system. Auditors may also check the system. They may ask to see proof of canceled checks. If the canceled check is retained, the business can show it. This makes the business look professional and controlled. Procedure D. The tasks of writing checks and writing up the bank general ledger account are to be carried out by different people. This means one person writes the check. Another person records the payment in the accounting system. The same employee must not do both jobs. This is one of the strongest controls in accounting. This control is called separation of duties. It is a very important concept. This is a good control for several reasons. First reason, it prevents one person having too much power. If one person can write checks, they can send money out. If the same person can also record the payments, they can hide what they did. For example, a dishonest person could write a check to themselves. Then they could record it as office supplies. That would be fraud. But if two people are involved, fraud becomes harder. The second person can notice unusual payments. The second person can ask questions. The second person can refuse to record something that looks wrong. Second reason, it reduces mistakes. Even honest people make errors. They may write the wrong amount. They may write the wrong supplier name. They may record the payment twice. But when duties are separated, there is a checking effect. One person prepares, the other person records and reviews. This reduces mistakes. Third reason, it increases accountability. When roles are separated, everyone knows their responsibility. This creates discipline. This creates better control over money. Procedure E. Authorized details of all standing orders and direct debits are to be filed, and the details of any such payments are to be agreed to the file before being transferred from bank statements into the bank general ledger account. This procedure is very important. Standing orders and direct debits are automatic payments. A standing order is when the business tells the bank to pay a fixed amount regularly. A direct debit is when a supplier takes money from the business account automatically. Now, the procedure says two major things. First, the business must keep a file of authorized payments. This file includes all standing orders. This file includes all direct debits. Authorized means approved properly. Second, when a payment appears on the bank statement, the business must check it. They must check that it matches the authorized file. Only after checking should they record it in the bank general ledger. This is a good control for several reasons. First reason, it ensures the payment is approved. Not every bank payment is correct. Sometimes a supplier takes the wrong amount. Sometimes a direct debit is set up by mistake. Sometimes a payment continues when it should have been canceled. So the business must check each payment against what was authorized. Second reason, it prevents unknown payments. A payment might appear on the bank statement unexpectedly. If the business records it without checking, that is risky. Checking the authorized file prevents this risk. It helps the business identify wrong payments early. Third reason, it improves accuracy of recording. Payments must be recorded under correct accounts. For example, rent should go to rent expense. Electricity should go to electricity expense. If the business checks the authorized file first, they can record correctly. Fourth reason, it supports completeness and control. Completeness means all real payments are recorded. Control means only correct payments are accepted. This procedure supports both. Now I will give you the final teacher conclusion. Students, these procedures are used because businesses must protect their money. A business must prevent fraud. A business must prevent mistakes. A business must record payments correctly. A business must keep strong evidence. A business must be able to explain every check and every payment. That is why these procedures are important. Each one creates better control. Each one creates better accuracy. Each one reduces the risk of losing money. Lesson 2. Introduction to posting cash payments to the general ledger. In this lesson, we practice how to record payments that leave the business bank account. Every time the business pays money, we must show where the money went. We also must reduce the bank balance because cash has left the business. The important idea is this. For every payment, bank is always one side of the entry. Because money is leaving the bank, bank will be credited. So the rule becomes very easy. Credit bank for the amount paid. Debit the expense or asset or payable account for the reason of the payment. Now we will post each transaction one by one. We will finish one transaction completely, then we move to the next transaction. Transaction 1. Payment to Ferdy in full settlement of an invoice. Information given. Libra paid $120 to supplier Ferdy. This payment is the final settlement for an invoice that was $130. They took advantage of a discount of $10. Let us understand what happened. The business owed Ferdy $130. The supplier allowed a discount of $10. So the business paid only $120. The payable to Ferdy becomes zero after payment. Now we record it. Step 1. Reduce what we owe to Ferdy. That means we debit trade payables for Ferdy with $130. Step 2. Record the discount received. Discount received is income for the business, so we credit discount received with $10. Step 3. Record the payment from bank. Bank went out by $120, so we credit bank with $120. Check the total. Debit side is $130. Credit side is $10 plus $120. That equals $130. So it balances. So the posting for transaction 1 is debit trade payables Ferdy, $130. Credit discount received, $10. Credit bank, $120. Transaction 2, payment to Kira in full settlement of an invoice. Information given. Libra paid $310 to supplier Kira. This was in full settlement of an invoice totaling $330. They took advantage of a discount of $20. Let us understand what happened. The business owed Kira $330. They received a discount of $20, so they paid only $310. After the payment, the payable to Kira becomes zero. Now we record it. Step 1. Reduce what we owe to Kira. Debit trade payables Kira with $330. Step 2. Record discount received. Credit discount received with $20. Step 3. Record the bank payment. Credit bank with $310. Check the total. Debit side is $330. Credit side is $20 plus $310. That equals $330. Balanced. So the posting for transaction 2 is debit trade payables Kira, $330. Credit discount received, $20. Credit bank, $310. Transaction 3. Paying cash for telephone expenses and gas to be recorded as expenses. Information given. Libra paid $400 for telephone expenses. Libra also paid $280 for gas. Both payments must be recorded as expenses. Here we have two separate expense payments. We record them clearly. First, the telephone expense payment. Step 1. Record the expense. Debit expenses with $400. Step 2. Record the payment from bank. Credit bank with $400. Now the gas expense payment. Step 1. Record the expense. Debit expenses with $280. Step 2. Record the payment from bank. Credit bank with $280. What does this mean? The business has used services. Telephone and gas are costs of running the business, so expenses go up on the debit side and bank goes down on the credit side. Transaction 4. Purchase of a non-current asset. Information given. Libra purchased a non-current asset for $1,500. A non-current asset is something the business will use for more than 1 year. For example, equipment, machinery, or a computer system. This payment is not an expense. It is an asset purchase. So we record it like this. Step 1. Record the asset. Debit non-current assets with $1,500. Step 2. Record the payment. Credit bank with $1,500. Transaction 5. Stationery purchase. Price includes sales tax. Information given. Libra purchased stationery for $97. This amount is inclusive of sales tax of $16.17. This means the $97 includes two parts. One part is the real cost of stationery. The other part is sales tax. We must separate them because sales tax is not part of the stationery expense. Sales tax is usually a liability, meaning money collected for the tax authority or a tax amount to be paid, so we split it. Total paid is $97. Sales tax inside it is $16.17, so the stationery cost is the remaining amount. Now we calculate the stationery cost. $97 minus $16.17 equals $80.83. So the entry becomes Step 1. Record the stationery expense or purchase. Debit expenses with $80.83. Step 2. Record the sales tax. Debit sales tax with $16.17. Step 3. Record the payment from bank. Credit bank with $97. Check the total. Debit side is $80.83 plus $16.17. That equals $97. Credit side is $97. Balanced. So the posting for transaction 5 is debit expenses, $80.83. Debit sales tax, $16.17. Credit bank, $97. Final check. What is happening inside the bank account? Now we look at all money leaving the bank. Bank will be credited for every payment. The bank credits are 1. $120 for Ferdy. 2. $310 for Kiera. 3. $400 for telephone expense. 4. $280 for gas expense. 5. $1,500 for the non-current asset. 6. $97 for stationery. So bank is reduced by the total of all those payments. Final check. What is happening inside trade payables? Trade payables is reduced when we pay suppliers. So trade payables will be debited by 1. $130 for Ferdy. 2. $330 for Kiera. And discount received is credited by 1. $10 for Ferdy. 2. $20 for Kiera. This is how the general ledger shows the full story. It shows who we paid. It shows the discount benefit we received. It shows the expenses we paid. It shows the asset we bought. And it shows the sales tax amount separately. Class, now we move to Lesson 2.2, Recording Payments. In Lesson 2.1, we learned how to post cash payments to the general ledger. That was the manual way of thinking. We looked at each payment and we posted it using double entry. Now in Lesson 2.2, we learn what happens in a computerized accounting system. This is very important because most real businesses do not post everything by hand. They use software, and the software helps them record payments faster and with fewer mistakes. So today, I want you to imagine you are working in the accounts department of a real company. You are the accounts clerk. Your job is to record supplier payments properly and make sure the system updates everything correctly. Lesson 2.2. What does recording payments mean in a computer system? When a business pays a supplier, two things must happen at the same time. First, the supplier account must be updated, meaning we must reduce what we owe to that supplier. Second, the bank account must be updated, meaning we must show money has left the bank. In manual accounting, we do that using a journal entry like this: debit trade payables, credit bank. But in a computer system, we usually do not type the full journal entry every time. Instead, we enter the payment once, and the system creates the double entry automatically. So please remember this golden sentence. In a computer system, when we update the payables ledger for a payment, the bank and trade payables in the general ledger will update automatically. That is exactly what Lesson 2.2 is teaching. Why is this automatic update useful? Now let me explain why business is like this. 1, it saves time, because we do not repeat the same work in different places. 2, it reduces errors, because the system posts the double entry correctly. 3, it keeps the ledgers consistent. The supplier record and the general ledger record match each other. 4, it makes reporting easier. At any moment, the business can see how much is owed to each supplier, how much has been paid, what is the bank balance, what is the total trade payables balance. So this is not only accounting, this is control and organization inside the business. What is the payables ledger inside the computer? Let's make it very simple. The payables ledger is like a file of supplier accounts. For example, Ferdy account, Kira account, Rapid Supplies account. Any supplier the business buys from. Each supplier account shows invoices we received, credit notes we received, payments we made, the balance we still owe. So the payables ledger is the detailed record for each supplier. Then the general ledger has a summary account called trade payables. Trade payables in the general ledger shows only the total amount owed to all suppliers combined. So you can think like this. Payables ledger is detailed. General ledger is summary. Now the computer links them together. How does the computer help us pay suppliers? In a computerized payables ledger, there is usually a payment function. This payment function can do 2 big jobs at the same time. Job 1, it can record the payment in the supplier account. Job 2, it can issue the payment, meaning it can create and print a check. So you are not only recording, you are recording and paying at the same time. That is why the book says the system can record and issue checks at the same time. Now I will explain the process like a classroom walkthrough, step by step. Step 1, the business decides which suppliers must be paid. Before we even touch the computer, someone must decide which invoices are due. Usually the accounts department prepares a list of unpaid invoices. Then a manager checks it, approves it, and authorizes payment. So the payment decision comes first. The recording comes after. Step 2, the accounts clerk opens the payments section in the payables ledger. In the book, we can see a menu on the screen. It is basically a list of options the system can perform. For example, the system may show options like provisional payments list, automatic payments, checks, credit transfers, remittance advice notes, and other options. Do not worry if the menu looks long. You do not need to memorize every line. What you must understand is the purpose. The software is giving you tools to manage payments properly. Step 3. The clerk selects the checks option or the automatic payments run. If the business is paying suppliers by check, the system can produce computer-printed checks. This is common in many accounting systems. So the clerk chooses the correct payment method. Step 4. The clerk enters the key information required for the payment. The book explains that the clerk will be given certain information. The most important ones are the supplier's code number. This is the short code the business uses to identify the supplier in the system. For example, instead of typing Rapid Supplies every time, the supplier might be coded as something like RAP or 01 RAP. The amount to be paid. This must match the approved invoice amount after adjusting for credit notes or discounts, if any apply. The date the check is to be paid. Sometimes the check is prepared today. Sometimes the business prepares checks now, but dates them for a later date. So these 3 items are the big ones: supplier code, amount, date. Sometimes the system also asks for invoice references or what the payment is for. But in this lesson, the key idea is that the system needs enough information to create the payment correctly. Step 5. The system performs several tasks automatically. Now class, this is the most important part. This is the heart of lesson 2.2. Once the clerk enters the payment, the system automatically does multiple updates. Let's go through them one by one. Automatic task 1. The check is printed. The system prints the check, ready for signing. So the check physically exists, but it still needs an authorized signature before it can be sent. Automatic Task 2. The supplier account in the payables ledger is updated. This means the supplier's balance is reduced. The invoice is marked as paid or partly paid. So if the supplier had an unpaid invoice, the system removes it from the outstanding list. That is how the system keeps the supplier record correct. Automatic Task 3. The bank general ledger account is updated. This is very important. As soon as the system records that a check has been issued, it updates bank in the general ledger. So bank decreases immediately. This is because accounting records payments when they are made, not when the supplier cashes the check. So even if the check has not gone through the bank yet, the business still treats it as a payment made, because the check has been issued and sent. Automatic Task 4. The trade payables general ledger account is updated. This means the total trade payables balance in the general ledger is reduced. So now we have the full double entry done automatically. Trade payables goes down, bank goes down. The system does the debit and credit behind the scenes. This is why the book says updating the payables ledger causes the bank general ledger and trade payables general ledger to be automatically updated. Automatic Task 5. A remittance advice may be produced. Many systems print a remittance advice with the check. This remittance advice tells the supplier which invoice is being paid, how much is being paid, the payment date, and any credit notes included. This helps the supplier match the payment to the invoices. So it prevents confusion, it prevents disputes. It also reduces phone calls and emails. Automatic Task 6. A record is kept for control and future checking. The business may keep a printed list of checks issued. This helps for queries later. For example, if the supplier says we did not get paid, the business can check number, date, amount, supplier, and then confirm what happened. So this system improves control over payments. Important point. Why are checks printed on special check paper? The book explains that checks must be printed on special blank check paper. This paper is usually provided by the bank. It includes special features, such as the magnetic numbers at the bottom. These are used by the banking system for processing. So the business cannot just print a check on normal office paper. It must be the correct check paper. Otherwise, the bank cannot process it properly. A simple example, so the process becomes very easy in your mind. Now, class, let's do a simple example to see how the computer behaves. Imagine Rapid Supplies is a supplier. They have an invoice of $500 due. The manager approves the payment. Now the clerk enters the payment into the system. The clerk types supplier code for Rapid Supplies, amount $500, date today. Now the system automatically does this. It prints a check for $500 to Rapid Supplies. It reduces Rapid Supplies' balance in the payables ledger by $500. It credits bank in the general ledger by $500. It debits trade payables in the general ledger by $500. It may print a remittance advice with invoice details. So in one action, everything is updated. That is why computerized systems are powerful. Very important exam understanding. If an exam question asks, in a computerized system, what happens when payments are recorded in the payables ledger? Your key answer should include this idea. The payables ledger update automatically updates the bank general ledger account and the trade payables general ledger account. And you can also add, the check can be printed ready for signature. The supplier account is updated. A remittance advice may be generated. The invoice is marked as paid. That is a strong exam answer. Common mistakes students make and how to avoid them. Mistake 1. Students think the payment is recorded only when the check clears the bank. No. In accounting records, the payment is recorded when the check is issued because the business has made the payment decision and has sent the check. Mistake 2. Students think the payables ledger and general ledger are separate and unrelated. No. In a computer system, they are connected. The payables ledger is the detailed record. The general ledger is the summary. The system keeps them in agreement automatically. Mistake 3. Students forget that the clerk needs the supplier code. Always remember, supplier code is used to find the correct supplier account inside the system. That is why supplier codes exist. Quick classroom recap. Let us recap Lesson 2.2 in the simplest possible way. A computerized payable system allows the business to record supplier payments efficiently. The clerk enters the supplier code, the amount, and the date. The system can print the check. The system updates the supplier account in the payables ledger. The system updates trade payables in the general ledger. The system updates bank in the general ledger. So one entry creates the full double entry automatically. All right, class. Now we move to lesson 2.3, which is recording in the payables ledger and the bank general ledger account. This lesson is very important because it explains what happens inside the system after we record and issue a supplier payment. It also teaches us a real problem that can happen if the system allocates the payment to the wrong invoices. So we need to understand both the advantage and the risk. Let's start slowly and clearly, like we are in a real accounts office. Lesson 2.3. The main idea. When a payment is made to a supplier, the computer system will normally do two updates automatically. 1, it updates the supplier's account inside the payables ledger. 2, it updates the bank account inside the general ledger. So the system is keeping two important records correct at the same time, the detailed supplier record and the company's bank record. Now let's break those two parts down carefully. Part 1. What does recording in the payables ledger mean? The payables ledger is the list of individual supplier accounts. Each supplier account shows invoices that we owe, credit notes we received, payments we made, and the remaining balance. So when we pay a supplier, we must reduce what we owe them. That reduction must be shown in the supplier's account. In a computer system, this is usually done by matching the payment against specific invoices. Think of it like this. The supplier account has several unpaid invoices sitting inside it. When we make a payment, the system needs to know which invoice cleared by that payment. Very important sentence for your understanding. A payment to a supplier is not only money going out, it is also closing the invoices that were unpaid. That is why payables ledger recording is not just entering an amount, it is also selecting and clearing invoices. Part 2. What does recording in the bank general ledger account mean? The bank general ledger account is the company's main bank record inside the general ledger. When we make a payment, money leaves the bank, so the bank account must decrease. In a computer system, once the payment is entered, the bank account is updated automatically. So as soon as the check is issued or the payment is processed, the bank account in the general ledger is reduced. This is important for control because the business needs an updated bank figure in the records. Now let's bring these two parts together in a realistic classroom example. Classroom example. Paying a supplier that has many invoices. Imagine we have a supplier called Rapid Supplies. Inside the Rapid Supplies supplier account, we have these unpaid invoices. Invoice 1 for $300, Invoice 2 for $200, Invoice 3 for $500. So total owed is $1,000. Now suppose the company decides to pay Rapid Supplies $600 today. Here is the key question. Which invoices are we paying with the $600? Because we cannot just reduce the total balance. We must also show which invoices are now cleared and which invoices are still unpaid. What the computer will normally do automatically. Most payables ledger systems are designed to allocate or match the payment automatically. What does that mean? It means the system will automatically choose which invoices get paid first. And the most common rule is the system pays the oldest invoices first. So in our example, the system will probably do this. Pay invoice 1, $300. Pay invoice 2, $200. Then use the remaining $100 to partly pay invoice 3. So after the payment, the supplier account will show invoice 1, fully paid. Invoice 2, fully paid. Invoice 3 still has $400 unpaid, and the supplier balance will now be $1,000 minus $600 equals $400. So far, everything looks correct. Now let's connect this to the general ledger. What happens in the general ledger automatically in our SAS? At the same moment, the system also posts the double entry. Trade payables decreases by $600. Bank decreases by $600. So you can imagine the journal entry that the computer creates behind the scenes. Debit trade payables, $600. Credit bank, $600. So the payables ledger is updated in detail, and the general ledger is updated in summary. That is the perfect situation. Now, the book teaches us something very important, a real problem that can happen with automatic matching. Sometimes the system may allocate the payment in a way that is not correct. Why can this happen? Because the system is following an automatic rule. It might be paying the oldest invoices first, but in real life, that is not always what the company wants. Let me explain this very clearly. Sometimes a supplier account has old invoices that should not be paid yet, or they might already have been paid, but the record was not updated properly. Or the company might be paying a specific invoice only, not the oldest one. So if the system automatically removes old invoices from the account when the payment is entered, it might remove the wrong invoice. This is exactly the warning in Lesson 2.3. The system might automatically remove invoices in the balance until the payment amount is used up. But this might not be correct. So what is the solution? The accounts clerk must check the invoices being removed. This is where the clerk's responsibility becomes very important. When the system shows the payment allocation, the clerk should check carefully which invoice numbers are being cleared, whether those invoices are approved for payment, whether the amounts are correct, whether any credit notes should be applied first, whether any early settlement discount should reduce the payment. So the clerk is not just typing numbers, the clerk is checking accuracy. This is a key accounting skill, because businesses do not just want speed, they want correctness. Let's do a small example so you never forget this idea. Suppose Rapid Supplies has these unpaid invoices. Invoice 1, $300 from a long time ago. Invoice 2, $300 from last week. Now the manager says, pay only invoice 2 because invoice 1 is in dispute, meaning the company does not agree with invoice 1. Maybe the goods were damaged. Maybe the supplier overcharged. So the company is not paying it yet. The clerk enters a payment of $300. If the system automatically pays the oldest invoice first, it will clear invoice 1. That is wrong, because the company wanted to pay invoice 2, not invoice 1. So the clerk must override the automatic matching. The clerk must select the correct invoice. That is why Lesson 2.3 is important. It is teaching you that computer systems help us, but they still require human checking. Now let's move to the bank side again, because the lesson also talks about records in the bank account. Recording in the bank general ledger account. When the payment is recorded, the bank general ledger account is updated automatically. But there is something else important here. Payments are often made in batches, meaning a company does not make one payment only. They make many payments during the day or during the week. So a payable system may issue many checks one after another. For example, check 1, $600. Check 2, $1,200. Check 3, $400. Now imagine doing this manually. It would take a lot of time. It would also be easier to make mistakes. So the system records the payments and updates the bank automatically. The book also explains an important control idea. The system will often print a list of checks issued as a record. This list is very useful, because later if someone asks, did we pay this supplier? Which check number was it? When did we issue it? How much did we pay? The accounts team can check the printed list. Also, if there is a problem later, the printed list helps the business investigate. So you can think of this list as evidence. It supports internal control and reduces confusion. Very important accounting idea. Issued checks versus cleared checks. Now, class, I want you to understand one more important point. When we issue a check, it is recorded as a payment immediately in the accounting records, but it might not appear on the bank statement until later. Why? Because the supplier might not deposit the check immediately, or the bank might take time to process it. So for a short time, there can be a difference between the bank account balance in the ledger and the bank account balance on the bank statement. This difference is normal. And later, in bank reconciliation, we adjust and explain that difference. So Lesson 2.3 is also preparing you for later chapters, especially bank reconciliation. Quick classroom recap of Lesson 2.3. Now let's summarize the full lesson clearly. When payments are recorded in a computerized payables ledger, 1. The supplier account in the payables ledger is updated. 2. The system may automatically allocate the payment to invoices, often starting with the oldest invoices. 3. This automatic allocation might not always be correct, so the accounts clerk must check and correct the invoice matching when needed. 4. The bank general ledger account is updated automatically. 5. Trade payables in the general ledger is updated automatically as well. 6. The system may print a list of checks issued and keep it as a record for control and future checking. That is lesson 2.3. If you're ready, next we can go to lesson 3, which introduces automated credit systems and how payments can be made and recorded electronically. Class, now we begin lesson 3. Lesson 3 is called Automated Credit Systems. This lesson is very important because it teaches you how modern businesses make payments without using cash or checks. In real life, many payments are made automatically through banks. So if you want to understand real accounting, you must understand automated credit systems. Now please listen carefully because I will explain this lesson like a full classroom lecture. I will speak slowly and clearly, and I will keep the language very simple. Lesson 3. What is an automated credit system? An automated credit system is a system that allows money to move from one bank account to another bank account using electronic methods. It means the payment is made through computers and banking networks. No physical cash is carried. No check is written. The payment happens electronically. So automated credit systems are also called electronic payment systems. This is how many businesses pay today. Why do businesses use automated credit systems? Businesses use automated credit systems for many strong reasons. Reason 1. It is fast. Electronic payments can be processed much quicker than checks. A check might take days to clear. An electronic payment can be completed much sooner. Reason 2. It is safe. Carrying cash is risky. Cash can be lost. Cash can be stolen. Checks can also be lost in the post. But electronic payments reduce those risks. Reason 3. It reduces paperwork. Checks require printing. Checks require signing. Checks require sending and filing. But electronic payments reduce this extra work. Reason 4. It improves control and tracking. When money is moved electronically, the bank statement shows clear details. Payments can be traced and matched to records. So it becomes easier to check if a payment happened or not. Reason 5. It supports regular payments. Automated systems make it easier to pay regular bills. For example, rent, taxes, electricity, and telephone bills. Many of these are paid automatically each month. So you can see, automated credit systems help businesses operate smoothly. What types of payments are included in automated credit systems? Now, in this lesson, you must understand that automated credit systems cover several payment types. Some automated payments are made by the business. The business sets them up and sends them out. Other automated payments are collected by the supplier. The supplier collects money automatically with permission. So we have different forms, but they all share the same idea. The payment is electronic. The payment is automatic or computer controlled. The payment moves through the bank system. Examples of automated credit systems include standing orders, direct debits, electronic transfers to suppliers, electronic payment of wages and salaries, bank credit transfers. In this lesson, we do not go into deep details of each one yet. That is what lesson 3.1 and the next points will do later. Today, lesson 3 is giving you the big picture, so focus on understanding the main concept first, how automated credit systems change the work of accounting. Now, I want you to imagine a real accounts office again. In the past, if a business wanted to pay a supplier, they would write a check. Then they would post the check entry into the ledger. Then they would wait for the check to clear. But with automated systems, the payment can happen without anyone writing a check. Sometimes the payment happens because it was programmed. Sometimes it happens because the supplier collects it. Sometimes it happens because payroll automatically sends money to employees. So the accountant's job changes. The accountant must focus more on control. The accountant must focus on authorization. The accountant must focus on checking the bank statement regularly. The accountant must make sure that only correct payments are allowed to happen. So in a modern system, the accountant becomes a manager of controls, not just a person writing entries. Main benefits of automated credit systems. Now class, let me explain the benefits in a simple way that you can remember easily. Benefit 1, convenience. Payments can be made without visiting the bank. Payments can happen without writing checks. Benefit 2, fewer delays. Payments arrive faster, so suppliers are paid on time. This helps business relationships. Benefit 3. Less risk of dishonored checks. A dishonored check means the check is not paid by the bank. This can happen if there is not enough money in the bank account. Automated systems reduce this issue because payments are usually checked and controlled. Benefit 4. Better record keeping. Electronic payments show on the bank statement, so it becomes easier to reconcile. It becomes easier to prove that payment was made. Benefit 5. Supports planning. When payments are regular, the business can plan its cash flow better. This means the business can manage money properly and avoid shortages. Main risks and controls needed in automated credit systems. Now, even though automated systems are good, they still have risks, so the business must have strong controls. Risk 1. Wrong amount paid. If the system is programmed wrongly, the wrong amount can go out. Risk 2. Wrong person paid. If bank details are entered incorrectly, money can go to the wrong account. Risk 3. Payment continues when it should stop. For example, a direct debit may continue even after a service is canceled. That can waste money. Risk 4. Fraud risk. If someone sets up a false payment instruction, money can be stolen. Risk 5. Lack of immediate visibility. Sometimes payments happen automatically, and staff may not notice immediately unless they check the bank statement and reports. So what controls are needed? Control 1. Only authorized people should be able to set up automated payments. Control 2. Payment instructions should be checked carefully before approval. Control 3. Bank statements must be reviewed regularly. Control 4. Bank reconciliation must be performed regularly. Control 5. Supporting documentation must be kept for every automated payment instruction. So remember, automated systems reduce manual work, but they increase the need for good checking. Connection between automated credit systems and bank reconciliation. This is very important, and I want you to remember it. Automated payments often appear on the bank statement without warning. For example, direct debits. So if the business does not record them, the records become incomplete. That is why bank reconciliation becomes even more important. Bank reconciliation helps detect payments that happened but were not recorded, wrong amounts taken, unexpected payments, duplicate payments. So automated credit systems and bank reconciliation work together. They support accuracy and completeness. Classroom summary of Lesson 3. Now let me summarize Lesson 3 in a very clear way. Lesson 3 teaches us that modern payments are often made electronically through banks. These systems are called automated credit systems. They are used because they are fast, safe, and convenient. They reduce paperwork and help businesses pay on time. Examples include standing orders, direct debits, and electronic transfers. But automated systems still need strong controls. The business must authorize instructions properly. The business must check bank statements regularly, and the business must perform bank reconciliation to ensure completeness and accuracy. That is Lesson 3. 3.1. Procedures for using automated credit systems. Chapter 9. Recording payments. Class, in this lesson, we are learning the practical, real-life process of how a business pays people or organizations using an automated credit system. An automated credit system means the payment is done electronically through the banking system, instead of writing a check or paying cash. This system is commonly used for things like standing orders, direct debits, salaries paid monthly, wages paid weekly, some one-off payments. The main reason businesses like automated credit systems is simple. They reduce paperwork, they reduce delays, and they improve security. Now let us go through the procedure step by step, exactly like the book shows it, but with full teacher explanation so you understand it deeply. Step 1 of Lesson 3.1. The company prepares the payment file. Class, now we are focusing only on Step 1. This step is the foundation of the whole automated payment process. If Step 1 is done correctly, everything after it becomes easy and safe. If Step 1 is done badly, the company can pay the wrong person, pay the wrong amount, or miss someone completely. So please take this step seriously, because in real life, this is where most mistakes happen. What does prepare a payment file mean? A payment file is a digital list of payments. It is not a paper list. It is a computer file. It contains instructions for the bank system. The message inside the file is simple. It says, please transfer money from the company bank account to these people. Pay these amounts. Send each amount to the correct bank account. So we can say it like this. A payment file is a set of electronic payment instructions. Why do businesses use a payment file instead of checks? Let us compare it with checks. If a company has 100 employees and it pays salary by check, then the company must do these things. Write 100 checks, sign 100 checks, record 100 checks, deliver 100 checks. That takes a lot of time. It also creates a lot of paperwork. But with an automated credit system, the company can prepare one payment file. That one file contains all payments. Then the bank system processes everything automatically. So the payment file saves time, it saves paperwork, it reduces delays, it improves control and security. Who prepares this payment file? Normally, the accounts department prepares it. Often it is the payroll section inside accounts. In a small business, it might be one accounts clerk. In a large company, it might be a whole payroll team. The key point is this. The person preparing the file is not just typing numbers. They are creating real bank payment instructions, so they must be accurate and careful. What information must be included in the payment file? The book tells us the file includes details of each member of staff to be paid. The main items are full name, amount to be paid, bank or branch number, bank account number. Now I will explain each one slowly and clearly. Item 1, full name. The file includes the full name of the employee. Why is the name important? The name helps the company identify the person clearly. It also helps in checking and reviewing. It helps when staff ask questions later. For example, an employee might say, "My salary did not arrive." The company can search the file by the employee's name. Then the company can confirm whether the employee was included. Teacher note: even though banks mainly rely on account numbers, the name is still a useful reference for human checking. Item 2, amount to be paid. This is the exact salary or wage for that employee. This amount must be correct. Because salary is sensitive, employees depend on it. Let us take a simple example. Ali will receive $1,000. Sarah will receive $2,000. John will receive $1,500. The payment file must show those exact amounts, not $1 more, not $1 less. Teacher note: in real payroll, the amount may already be calculated by the payroll system, but the accounts team must still check the totals, because if the data is wrong, the payments will be wrong. Item 3, bank or branch number. This is a banking code that identifies the bank and sometimes the branch. Different countries use different codes, but the purpose is always the same. It tells the system where the employee's bank account belongs. So you can think of it like a bank location identifier. If this code is wrong, the payment may fail, or the payment might go to the wrong bank route. That is why companies usually keep employee bank details saved in a master file. They do not want to type it again and again every month. Item 4, bank account number. This is the most critical piece of information. The bank account number is the destination for the money. It is the place where the employee must receive the salary. If the account number is wrong, the company may pay the wrong person. So the account number must be checked carefully. Teacher note: this is why businesses do not allow random changes to bank details without proper approval, because a fraudster could change the account number and steal the salary. How the company collects this information. Now let us talk about how the company gets this information in the first place. Normally, when a new employee joins, they complete a starter form. They provide their bank details. They provide their personal information. Then the company records those details in the payroll system. After that, every pay period, the payroll system uses the stored details to prepare the payment file. So step 1 often means extract the list of employees and amounts. Attach the correct bank details. Create the payment file in the correct format. What does the payment file look like in practice? In real life, the file might be a bank payment file created by payroll software, a spreadsheet exported into a bank format, a secure upload file for online banking, a direct connection file sent to a processing center. But do not worry about the technical format right now. In FIA FA1, what matters is the logic and the control. The file is a digital instruction list. Checks that must happen during step 1. Now class, step 1 is not just preparing the file. Step 1 also involves checking the file. Because a payment file is powerful, once it is sent, money moves, so the company must check at least these points. Check 1. Every employee who should be paid is included. This prevents missing payments. Check 2. No extra or fake employee is included. This prevents fraud. Check 3. Each amount is correct. This prevents underpayment and overpayment. Check 4. The bank details match the employee records. This prevents sending money to the wrong place. Check 5. Total payroll amount makes sense. For example, compare total payroll this month to last month. If it is suddenly much higher, the company investigates. Authorization before sending the file. In good businesses, the file is not sent immediately after being prepared. Usually there is authorization. That means a senior person reviews the file, then they approve it. This approval is a strong control. It reduces the risk of mistakes. It reduces the risk of fraud. So in practice, step 1 often includes 2 roles. Role 1, prepare the file. Role 2, authorize the file. That is strong internal control. A simple classroom example of step 1. Let us practice step 1 with a clear example. Imagine a company has 3 staff. Ali, Sarah, John. The payroll department calculates salaries. Ali will be paid $1,000. Sarah will be paid $2,000. John will be paid $1,500. Now the accounts clerk prepares the payment file. They enter employee name, Ali, amount, $1,000. Bank code, Ali's bank code. Account number, Ali's account number. Then they enter employee name Sarah, amount $2,000, bank code. Sarah's bank code, account number. Sarah's account number. Then they enter employee name John, amount $1,500. Bank code, John's bank code. Account number, John's account number. Now the file is ready, but before sending, the company checks. Are the 3 staff correct? Are the 3 amounts correct? Are the bank details correct? Is the total payroll equal to $4,500? If everything is correct, the file is approved. Then it will be sent in step 2. But we are not doing step 2 now, only step 1. Common mistakes in step 1 and how to avoid them. Mistake 1, typing the wrong account number. Solution, use saved employee bank records and double checking. Mistake 2, paying the wrong amount. Solution, compare amounts to payroll calculations and contracts. Mistake 3, missing an employee. Solution, reconcile the payroll list with the staff list. Mistake 4, paying a leaver who should not be paid. Solution, update payroll records immediately when someone leaves. Mistake 5, paying a fake employee. Solution, proper authorization and separation of duties. Final summary of step 1. Step 1 is preparing the payment file. The payment file is a digital instruction list. It tells the banking system who to pay and how much. The file must include the employee name, the amount to be paid, the bank code or branch code, the bank account number. Step 1 must also include careful checking and proper authorization, because once the file is sent, the money will move. If you understand this step properly, you will find step 2 and step 3 much easier. Step 2. The payment file is submitted to the automated credit processing system. Now class, remember what we did in step 1. In step 1, the company prepared a payment file. That file is a digital list of payments. It says who must be paid and how much must be paid. It includes each employee's bank details. Now step 2 is the action of sending that file into the banking system. So step 2 is basically this. The company sends the payment instructions to the bank system so the bank can start processing the payments. Why step 2 is necessary? The company itself cannot move money into employees' accounts directly. Only the bank can do that. So the company must communicate with the bank in an official way. That official way is the payment file. Think of it like ordering a delivery. You prepare the order first, that is step 1. Then you send the order to the delivery company. That is step 2. After that, the delivery company delivers the items. That is step 3. The bank is like the delivery company here, but instead of delivering boxes, it delivers money. How the company sends the file. In real life, companies usually send the file in one of these ways. Method 1. Upload through online business banking. The company logs in. They upload the payment file. They confirm the payment date. They send it for processing. Method 2. Payroll software sends it automatically. Some payroll systems connect with the bank system. The system sends the file securely. Method 3. Send to an automated processing center. Some banking systems collect files in one place. Then they distribute the payment details to different banks. Do not worry about the technology. What matters for FIA is the idea. The file is sent into the banking system. What happens inside the bank system during step 2? When the bank receives the file, the bank does not pay immediately. First, the bank checks the file. The bank checks things like, is the file in the correct format? Is the company allowed to send this file? Does the file contain valid bank account numbers? Are the bank codes correct? Is the payment date valid? Is the total payment amount reasonable? If something is wrong, the bank may reject the file, or the bank may reject only the wrong payments inside the file. This is very important because businesses do not want half the employees paid and half not paid. So businesses try to make step 1 and step 2 very accurate. Important timing point in step 2. A company usually sends the file before payday, not on payday. Why? Because the bank needs time to process the file. So businesses have deadlines, such as send the payroll file 1 or 2 working days before payday, sometimes more, depending on the banking system. That is why step 2 matters a lot. If it is late, staff will not receive money on time. Important control in step 2. In a good business, step 2 is not done by only one person without checks. Normally, there is approval. One person prepares the file. Another person authorizes the file to be sent. This reduces mistakes. This reduces fraud. Also, the business should keep evidence that the file was sent. For example, a confirmation message from the bank, a transmission report, a reference number for the payroll run, a copy of the file stored safely. This evidence is important later if someone asks, was I included in the payroll? Was my salary sent? When was it sent? Step 2 summary. Step 2 is sending the payroll payment file into the bank system. It is like giving the bank official instructions to pay employees. The bank receives it, checks it, and prepares it for payment processing. Now we move to step 3. Step 3 is the moment everyone is waiting for. This is payday. In step 3, the bank completes the transfers. The main idea is simple. Each employee's bank account is credited with their salary. The company's bank account is debited with the total payroll amount. Now I will explain credited and debited very clearly, meaning of credited and debited in a bank account. When we talk about a bank account for an employee, credited means money goes into the account. The balance increases. So credit means the employee receives money. When we talk about a bank account for the company, debited means money goes out of the account. The balance decreases. So debit means the company pays money out. This is extremely important to understand. Employee account receives money. Company account loses money. That is exactly what paying salaries means. What happens on payday in simple steps? On the chosen payment date, the bank system processes the file and does these actions. Action 1. The bank reads each employee payment line. Example, Ali receives $1,000. Sarah receives $2,000. John receives $1,500. Action 2. The bank transfers the money to each employee account. So the employees' accounts are credited. Ali account goes up by $1,000. Sarah account goes up by $2,000. John account goes up by $1,500. Action 3. The bank takes the total amount out of the company account. Total is $4,500. So the company's account is debited by $4,500. That is step 3. Very important note about totals. The bank does not usually debit the company account one time for each employee. Many systems debit it as one total figure. So on the company bank statement, you might see payroll payment, $4,500, while the employees will see their own salary amount separately. So you can remember it like this. Employees see individual amounts. Company often sees one combined amount. What if the company does not have enough money? This is a very important real-life point. If the company does not have enough funds, the bank may not process the payroll, or the bank may reject the payments. That is why companies check available funds before payday. They may also have an overdraft facility. That means the bank allows them to go below zero up to a limit. But even with an overdraft, there are still limits and rules. So step 3 depends on one big condition. The company must have enough money or enough bank permission to cover the payroll. What employees experience during step 3? From the employee side, it feels simple. They check their bank account. They see salary received. They can use the money. But inside the system, the bank has done a full electronic transfer. So even though it feels simple, it is actually very organized behind the scenes. what the company experiences during step 3. From the company side, the company wants to confirm 3 things. Number 1, the payroll has been processed. Number 2, the correct total has been taken from the bank. Number 3, there are no missing or rejected payments. The company can confirm this by checking the bank statement, the payroll processing report, the confirmation from the banking system. If there is a problem, the company will investigate quickly because employees will complain quickly. Mini classroom example of Step 2 and Step 3 together. Let us connect them as one story. Step 1, company prepares the file. Ali 1,000, Sarah 2,000, John 1,500. Step 2, company sends the file to the banking system. Bank checks file format. Bank checks details. Bank accepts it. Step 3, on payday, the bank pays the staff. Ali receives 1,000, Sarah receives 2,000, John receives 1,500. Company bank account is reduced by 4,500. That is the full flow. Step 3 summary. Step 3 is the actual payment day. Employees receive money. Their accounts are credited. The company pays the money. Its bank account is debited with the total amount. That is why Step 3 is the execution step. It is the step where the bank transfers real money. Very short final recap. Step 2. Send the payment file to the automated banking system. Step 3. On the payment date, the bank credits employees and debits the company. Step 4. All automated credit items are fully backed up. When a business uses an automated credit system, the business is sending a file of payment instructions. That file might be for salaries, or standing orders, or direct debits, or other payments. Step 4 is telling us something very simple but very powerful. Every payment instruction must be safely saved in more than one place. This is what we mean by fully backed up. So let us understand it clearly. 1. What does backed up mean here? Backing up means keeping a secure copy of the payment information. So even if something goes wrong later, the business can still prove what it did, and the business can still check the details. The backup usually includes things like the list of people or suppliers being paid, the amounts being paid, the bank account numbers, the payment date, the payment reference, any payment run number, batch number, or internal code. 2. Why do we need backups in real life? Because problems can happen, and when they happen, the accounts department must answer questions. For example, imagine these common situations. Example 1. An employee says, "I did not receive my salary." The account staff must check the payment file. They must confirm the account number and amount. They must confirm the date the payment was sent. Without a backup, the business is blind. It cannot easily prove what it sent. Example 2. The bank rejects a payment. This can happen if an account number is wrong, or the employee closed the account, or the bank details do not match. A backup helps the business trace exactly what happened. Example 3. The wrong amount is paid. Maybe an extra 0 is typed. Or maybe someone is missing from the file. Or maybe the amount was not updated. The backup helps the business investigate the mistake quickly and correctly. Example 4. Audit and inspection checks. Auditors often ask questions like, "Show me evidence of this salary payment. Show me the payment listing that created these transfers. Show me the control over who approved this payment run." A backup gives you that evidence. 3. What does the processing center do in Step 4? The book explains that the automated credit processing computer center also keeps records. This is important because the bank or processing center is handling thousands or millions of payments, so they need strong systems for security accuracy, tracking, recovery if something fails. 4. What does secure systems and business continuity mean? This part is about safety and continuity. Business continuity means the system can continue working even if there is a problem. For example, power failure, computer breakdown, network problems, cyber attack, system crash, natural disaster. If the processing center has strong backup and security, then payment data is not lost. Important files are protected. The business can continue operating. Clients can still receive support and records. So Step 4 is basically saying this. Automated payments must not depend on one single computer or one single file. They must be protected and recoverable. That is professional accounting control. Step 5. The business records are updated with the same information sent to the automated credit system. Now we come to Step 5. This step is about accounting entries. It is about making sure the business books match the payments that were instructed. The key message is, the same details that were sent in the payment file must also update the accounting system. So the business does not just pay money, the business must also record the payment properly. 1. Why step 5 is necessary? Because if you pay money and do not record it, your accounts become incorrect. Then you will have problems like bank balance in the ledger will be wrong, expenses will be missing, payables or payroll balances will not reduce correctly, financial statements will be incorrect, bank reconciliation becomes difficult. So step 5 protects the accuracy of the accounting records. 2. What updated means in practice? It means the accounting system posts the transactions. So the system records the payments in the general ledger. The exact double entry depends on what the payment is for. Let us use salaries as the easiest example, because lesson 3.1 used paying staff salaries. When salaries are paid, two things happen. The company's bank balance goes down, wages expense is recognized, so the posting could be debit wages expense, credit bank. Sometimes companies also use a payroll control account, but the simple idea is always the same. Money left the bank, and it was paid for wages. 3. Another example using the same step 5 idea. If the automated credit file is paying rent every month, then the update could be debit rent expense, credit bank. If the automated credit file is paying a supplier invoice, then the update could be debit trade payables, credit bank. So step 5 is teaching you the logic. Whatever you paid, your ledger must reflect it. 4. Why using the same information is so important? Because it reduces human error. If staff had to retype everything again into the accounting system, mistakes would happen. Examples of mistakes: wrong amount posted, wrong supplier account posted, payment posted twice, payment posted to the wrong date, payment missing from the books. But if the system updates the records using the same information from the payment file, then the payment instruction and the accounting record match. The bank ledger becomes reliable, checking and tracing becomes easier. 5. Step 5 also helps bank reconciliation. Later, when the bank statement arrives, the business can compare payments in the bank statement, payments recorded in the bank general ledger. Because the ledger was updated properly, matching becomes smooth and fast. Final classroom summary for steps 4 and 5. Step 4 is about safety and control. It makes sure every automated payment has proof and backup. It also makes sure the processing center has secure systems and continuity. Step 5 is about correct accounting. It makes sure the ledger is updated using the same payment information, so the business records remain accurate and reliable. The first question. In this question, the book gives you 2 statements. Your job is very simple. For each statement, you must decide if it is true or false. So this is a checking question. It is testing your understanding of one key idea. When do we record a payment in the accounting system? Here are the 2 statements in the question. Statement A says this idea. Check payments are recorded in the bank general ledger account only when the check has been presented at the bank, because only then the payment leaves the bank account. Statement B says this idea. Standing order payments made by the bank should normally be entered in the accounting system, but not when they are payments in advance for goods or services that are not received yet. So this is what the question is testing. It is testing timing. It is testing the correct time to record payments in the bank general ledger. Now the answer in full detail. The book says both Statement A and Statement B are false. Now I will explain carefully why they are both false. Explanation for Statement A. Statement A is false. The reason is that in accounting, we record payments when we make them. We do not wait until the bank processes them later. Let us make it very clear with an example. Imagine today is Monday. On Monday, the business writes a check to a supplier. The business has now made a payment decision. The check is part of the payment process. So the business must record the payment on Monday, even if the supplier goes to the bank on Thursday, even if the money leaves the bank on Thursday. Why do we record it on Monday? Because Monday is the date the business created the payment. That is the date the business is responsible for the payment. Now think about what would happen if we waited until Thursday. The accounts would be confusing. The bank ledger would not show the real situation. You would not know how many checks have been issued. You would not know what you have already paid. You would not know what payments are still in transit. So we record check payments as soon as the check is issued. That makes tracking easy. That makes control stronger. That makes checking easier later. A check payment is recorded in the bank general ledger when the check is written and sent, not when the check is later presented at the bank. That is why Statement A is false. Explanation for Statement B. Statement B is also false. Let us understand what a standing order is. A standing order is a regular payment. It is usually a fixed amount. It goes out automatically from the business bank account. For example, rent could be paid by standing order every month. Now, Statement B says something that sounds logical, but it is wrong. It says we should record standing orders, but not if they are payments in advance for goods or services not received yet. This is wrong because the bank general ledger is not about did we receive the goods. The bank general ledger is about cash movement. It is about money going out and money coming in. So if money goes out of the bank account, it must be recorded, always, even if it is a payment in advance, because the bank balance has reduced, and the accounting system must match the bank account. Now you might ask a very important student question. If we have not received the goods or services yet, what account do we debit? Excellent question. We still record the payment, but we choose the correct debit account. Here are two common possibilities. If it is an advance payment, we may debit a prepayment account. So we would record something like debit prepayments, credit bank. Later, when the goods or services are received, we transfer the amount from prepayments to the correct expense. If it is a deposit or an advance to a supplier, we may debit an account like supplier advances or a receivable type account. But the important point stays the same. Money left the bank, so we must record it immediately. If we do not record it, the bank ledger will be wrong. Then bank reconciliation will become difficult. A standing order must be recorded in the accounting system whenever it happens, even if the payment is in advance. So Statement B is false. Final teacher summary. The reason both statements are false is the same core idea. The bank general ledger is mainly about recording cash movement. So when money leaves the bank, record it. When money enters the bank, record it. Do not wait for later. Do not delay the entry. This rule keeps the bank ledger accurate. This rule makes bank reconciliation possible. This rule makes control over payments stronger. Second question. The second question says something like this. You are training new staff in your firm on the recording of payments. The task is, explain briefly each of these terms. A. Canceled check. B. Stopped check. C. Paid check. D. Bank reconciliation statement. So what is the examiner testing here? They are testing your practical understanding. They want to know if you understand these words, because these words are used in real offices every day. And if you do not understand them, you can easily record payments incorrectly. Now the answer. Let us take them one by one. A. Canceled check. Meaning of a canceled check. A canceled check is a check that was prepared, but it is not going to be used. So the business decides, we will not send this check to the supplier. Why would a check be canceled? There are many normal reasons. For example, the person writing the check made a mistake in the amount. The supplier name was written wrong. The wrong invoice number was written. The company changed its decision, and the payment should not be made yet. The amount changed, so a new check must be prepared. How do we cancel a check properly? In real office practice, you should not just throw it away, because someone could find it and misuse it. So the correct safe method is, draw a clear line across the check. Write the word canceled across the check. Keep the canceled check as part of the checkbook control or file it properly. Why do we keep it? Because check numbers must be controlled in sequence. If an auditor or a manager checks the checkbook, they should see what happened to every check number. So a canceled check is evidence that the check existed, but it was canceled safely. Important accounting point for students. If the check was canceled before any accounting entry was made, then nothing is recorded. But if the check was already recorded as a payment and then it was canceled, you must reverse the entry, because the payment will not happen. B. Stopped check. Meaning of a stopped check. A stopped check is a check that has already been issued or at least prepared, but the business asks the bank not to pay it. This is not the same as canceled. Canceled means the check will not be used and is removed inside the office. Stopped means the check might already be outside the office and the business needs the bank's help to block it. Why would a business stop a check? Common real reasons are: the check was lost in the post, the check was sent to the wrong supplier, the check amount is correct, but the payment should not be made because of a dispute, the check might have been stolen, the supplier says they never received the check and time has passed. How do you stop a check? The business contacts the bank and gives key details such as check number, check date, check amount, payee name, meaning who it was written to. Very important control point. Many banks may accept a stop request by telephone, but the instruction should be confirmed in writing as well. Also, banks often charge a fee for stopping a check. Now the accounting effect. This is very important for students. If the check was already recorded as a payment in the bank general ledger, and later you stop it, then one of two things will happen. First possibility: the check is stopped successfully and the bank does not pay it. In that case, the business must reverse the payment entry, because the money did not leave the bank. Second possibility: the check clears before the stop instruction reaches the bank. In that case, the payment has happened and it remains recorded. So the business must always check the bank statement to confirm what happened. That is why a stopped check is a control topic. It protects the business from incorrect or fraudulent payment. See paid check, meaning of a paid check. A paid check is a check that has been presented to the bank and then the bank has paid it. So the money has now left the drawer's bank account. The word drawer means the business that wrote the check. So when we say paid check, it means the check has gone through the banking system successfully. The supplier has received the money and the business bank account has been debited. What happens to the paid check physically? Usually, the bank keeps the check as part of their records. Or sometimes the bank may return it to the business with the bank statement, depending on the system used. Why is a paid check important for accounting? Because it is proof that payment truly happened. So when you reconcile, you can match the check number, the check amount, the check date with the payment shown on the bank statement. Teacher note for students. This is where many students get confused. A check can be recorded in the accounts before it becomes a paid check, because we record when we issue it, but it becomes a paid check only when it clears the bank. That time difference is one reason why bank reconciliation exists. D. Bank reconciliation statement. Meaning of a bank reconciliation statement. A bank reconciliation statement is a statement that explains the difference between the balance in the business bank general ledger account inside the accounting system and the balance on the bank statement, which comes from the bank FIA. These two balances often do not match on the same date, and that is normal. Why do they not match? Most of the time, it is because of timing differences, meaning one side has recorded something, but the other side has not recorded it yet. The most common timing difference is this: checks issued but not yet presented. This means the business wrote the check and recorded the payment, but the supplier has not yet banked the check, so the bank statement still does not show it. Another common timing difference is this: cash or money received and paid into the bank, but not yet processed by the bank, so the business has recorded it as a deposit, but the bank statement has not updated yet. There can also be bank errors or business errors, but timing differences are the most common in basic questions. What does a bank reconciliation statement do? It lists the reasons for the difference. It shows the adjustments needed so both records can be checked and trusted. And it confirms that the bank general ledger account is accurate and complete. Why is it so important? Because it is one of the strongest controls in accounting. It helps to detect missing payments, unrecorded bank charges, unrecorded receipts, errors, and sometimes fraud. So the bank reconciliation statement is like a safety check. It makes sure that the book balance and the bank balance can be explained clearly. Final classroom summary for students. Canceled check means it was never used, so it is crossed through and kept safely. Stopped check means the bank is instructed not to pay it, usually because it is lost or there is a problem. Paid check means the check has cleared the bank and the money has left the account. Bank reconciliation statement means the report that explains why the bank statement balance and the accounting bank balance do not match, mainly because of timing differences.